Welcome to the show. You have found Mason Street Retirement Insights, where every week we turn to our resident financial advisor, Sean Mason. He is the founder of Mason Street Wealth Management right here in Fresno. And he's been helping clients retire with confidence for years. He'd love to do the same for you. So he is here today to break down some of the biggest retirement topics for us. You know, Sean, thinking about it, one of the reasons Social Security remains such a hot topic is that people are looking for certainty. So they're wondering what benefits will look like down the road, what taxes might be, and how to create reliable income in their retirement. And so when it comes to planning ahead, there's another strategy I want to talk about. It's getting a lot of attention right now from both younger and older investors alike, and that is Roth accounts. The Wall Street Journal actually says that Gen Z is being called the Roth generation, and it's largely due to the advice that they're getting on social media.
Open a Roth IRA. Every dollar you put in grows tax-free forever.
I'm going to go through step-by-step how to invest your Roth IRA.
I took a look at my Roth IRA's contributions, and for the first time in my life, I'm glad to say that I maxed mine out. I'm going to show you exactly how I did it.
So 75% of Gen Z investors who contributed to an IRA in the first quarter chose a Roth account. But they're not the only ones embracing Roth strategies. Roth conversions by baby boomers also jumped 41% during that same period. So Gen Z may be getting the headlines, but boomers are making some big Roth moves too, Sean. So I'm wondering your thoughts on this. Why do you think this is happening?
I love that the Roth strategy is gaining steam. It's getting more attention. It's such a powerful strategy. In some situations, it's not going to be for everyone. I love that the Gen Zers are, paying attention and putting some thought to it. That's really good news for the future. We've been using Roth strategies, advanced Roth strategies for over 20 years. And I'm seeing more and more people, when they come in to meet with me, that they already started using a Roth. And that was unheard of maybe 4 or 5 years ago. And so it's really good to see that. Actually, families are coming in and they're asking for their kids. They're asking us, should our kids and our grandkids be directing their employment dollars into those 401k traditional side or the Roth side? So we love that. And I'll just mention as a side note to that, when we work with a family, we offer and we encourage the kids to come in, and we're going to help them kind of create their own financial plan. We believe that their parents, actually our clients, the people that we're working for, they're going to be better off, the better off that their kids are, and the earlier start they get, the better. So we really like that. But you brought up a really good point, Casey. Boomers, and I'll even add Gen Xers.
Okay.
They're questioning more and more. When they come in, one of their concerns is, should I be doing Roth conversions, and how's it work? And, what do I got to be looking at? I love that there's the awareness. They're becoming aware that this is something that they need to think about. Of course, tax-free money, tax-free distributions, we're all very interested in that. We can get really excited about that. The problem, though, that I see is decisions are being based on the perceived downside, not the overall benefits. People at this point, they haven't been able to figure out how to determine what the overall benefits of Roth conversions are. They like that idea of tax-free income, but they're really very focused on what the downside is going to be. And we all know it's the taxation. It's giving up money early in the form of taxes that we weren't planning on. And that's very understandable. They're worried that those taxes are going to have to be paid out of their cash flow, which is going to mean they have less cash flow into the household. They're worried about that they're going to enter into higher tax brackets, and that just doesn't feel good. They don't like the idea that portfolio value will go down. Of course, the portfolio value is going to go down if we have to take money out of it early to pay taxes. Mm-hmm. We've got to really start focusing in on, or I really encourage people to start focusing in on figuring out what the benefits are. You've got to understand, look, if we're going to have less money in the beginning, and we're doing that with the potential of having more money in the end, when is that break-even point? We need to figure that out. We also need to understand what's the difference in value of each dollar between a Roth versus a tax-deferred dollar. It's different for everybody because of the tax situation that they're in. Figure out the value of the Roth dollars compared to the value of the tax-deferred dollars in your portfolio, and that's going to help a lot. You also want to understand what the legacy value to the heirs are. Look, when we pass money to our kids, causes, family members, whoever it might be, we know that if it goes in traditional IRA form, they're going to have some significant tax liability on those dollars. And we did not sign up to give the majority of our savings that we sacrificed to create, give the majority of our savings away to the government in the form of taxation. So we really need to get a hold, an understanding on what the value of those Roth dollars are for our heirs in legacy. You know, tax dollars this year versus lifetime. I ask people, what's most important to you? And this is a good question to ask yourself. What's more important to you? The number of dollars you pay in taxes this year or the number of dollars you pay over your lifetime? And most of us, once you think that through, you're going to come to the conclusion that, look, the number of dollars you pay over your lifetime is what's most important. If we can save six figures, multiple six figures in taxation over our lifetime, what happens with those dollars? You know, we get to spend them, or they go to who we care about, kids, causes, instead of the government in taxation. You know, a lot of times people will suggest to me that they've gone to their tax professional. In fact, I've got a great example. We, a few months ago, sponsored a specific Roth conversion class. We did an educational class.
Very cool.
Specifically, on Roth conversions. It went over very well. And I'll tell you, there was about 22 families that came to that class, and about 15 of those families actually signed up to come and meet with us to kind of walk through more detail on their specific situation. Out of 15, we had 10 of those give us a call and tell us that they had talked with their tax professional, their CPA, and their CPA told them that they should not convert. I was able to get on with about 3 of those people, and about 3 of those people decided to go ahead and keep their meeting and come in. And all 3 of those people right now, we're implementing Roth conversion strategies. The reason is I went and talked with the tax professional. What I've found through time is that tax professionals typically, and I'm generalizing, there's some really good ones, but for the most part, tax professionals are really focused on how they can save us as many dollars as possible this year.
Right.
They're not necessarily considering the tax liability over our lifetime. So it's really important to understand.
No hate, no shade to the CPAs, but that's their job, is to focus on this calendar year.
That's for sure, and they can be really good at it. But we need something more advanced. We need to understand what that liability is going to be over our lifetime and what strategies are going to help us. So strategy determined by spendable income and legacy value. You've got to figure out what that value is to your spendable income while you're alive, and then the value to your heirs in legacy. And there's multiple elements that we have to consider. You know, tax brackets, required minimum distributions, RMDs, Social Security, Medicare premiums can be affected by tax scenarios and implementing Roth conversions. Widow's tax, you know, is probably the most unjust part of the tax code, is when one spouse passes away, the surviving spouse's tax liability goes up significantly, and we may be able to mitigate that utilizing Roth conversions. But, you know, advanced Roth calculations, that's is what's required to determine, you know, what type of strategy to use. We have proprietary calculation system. We have proprietary software that we can utilize to really help you determine how many dollars you should be converting. If you have $1 million in your IRA, should you convert 350,000? 700,000? Should you be converting the whole $1 million? That's going to be different for everybody. Everybody's situation different. And if you're going to convert a certain number of dollars, over what time frame should you do that? You know, some people should convert all of it in 2 years. Some people should spread it out over 8 years. And so, you know, I really want to encourage you to get your own individual Roth blueprint. That is a report that we generate utilizing our proprietary Roth calculation system.
Is that something special that you're going to offer today when it comes to Roth accounts?
Yeah, it really is. We're going to offer that as part of that comprehensive retirement plan assessment. But it's going to give you how much you should be converting and that time frame strategy. You know, should you be converting over 2 years or 8 years? It's going to cut your taxes and it's going to give you the most spendable income through your lifetime. It's the highest legacy value to your heirs. The bottom line is, what strategy should you be using to cut taxes? So give us a call, 559-847-0039. Our team is standing by right now.
And that's going to do it for us today here on the show. But Sean and I are going to be back next week with more retirement insight for Fresno. But until then, Sean, I'm going to hand it back over to you. Any final thoughts today?
Casey, it was a great time. You know, I love hanging out with you. You're always so much fun. And I love hanging out with our community. I got to tell you all how much I appreciate you tuning in. I just love the feedback that we're receiving on this show. I'm meeting so many great people. So many of you are coming into the office with that encouragement and, you know, having discussions with me. We are making an absolute difference. We can see that every day. I encourage you to keep coming back, keep tuning in. We're going to continue to bring you the information that you need to make this thing as great as possible. We care about your success. That's number one. So keep tuning in, and we're going to see you next week.
Mason Street Wealth Management, MSWM, is a registered investment advisor, and the opinions expressed by MSWM on this show are their own and do not reflect the opinions of Motivate Investments. Registration is not an endorsement by securities regulators. Investment advisory services are offered through Motivate Investments, an SEC-registered investment advisory firm. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. By contacting us, you may be provided with information about insurance products, including annuities, offered through Sean A. Mason, California, insurance license number 0B54860. The firms are separate entities. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company and are not offered by Motivate Investments. Read your contract for restrictions, limitations, or penalties. MSWM is not licensed in all 50 states. To find out if MSWM is licensed in your state, please call 559-892-0002.